Hi, I'm Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nate Ekman and Alan House. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note again that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve held the benchmark short-term interest rate steady in the range of 3.5 to 3.75% at its June Federal Open Market Committee meeting. This was the first FOMC meeting under the leadership of Chairman Kevin Warsh, who took the reins at an uncertain time for the central bank, as inflation accelerated this spring, exacerbated by oil prices. Our sense is that the Fed will pause on interest rate changes through the summer and early fall months to better assess inflation. There may be some relief coming on the pricing front. The primary reason is news that the United States and Iran have agreed to the framework of a deal to end the military fighting and reopen the Strait of Hormuz. An extended ceasefire would, in time, put downward pressure on oil prices and provide some needed help for the Fed. Both the May consumer and producer price index reports showed notable increases in the pace of price growth. The high cost of borrowing money is hurting parts of the U.S. economy. True, both manufacturing and non-manufacturing services activity is expanding and the labor market is holding up well. However, some of the interest rate sensitive sectors are struggling with both residential and, to a lesser extent, non-residential construction activity still running below historical averages. Higher mortgage rates and affordability concerns are pushing would-be buyers out of the housing market. On point, housing starts, down 8.2% year over year, fell well short of expectations last month, and the nation's largest home builders have a pessimistic near-term outlook. That said, artificial intelligence spending is the primary engine for the U.S. economy right now. The technology giants are pumping hundreds of billions into the AI infrastructure build-out, which is boosting gross domestic product growth and spurring corporate profits. The risk, though, is that the returns on these astronomical investments remain largely unproven for most businesses, and the increased need for energy to power the burgeoning AI revolution is contributing to inflation. In conclusion, after some profit-taking in early June, investors' appetite for riskier assets has returned, helped by the encouraging, though still very fluid, news on the war in Iran. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading on stocks, bonds, and cash. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line digital booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, first head to the dashboard where I am already located and then click on the investment survey under traditional online access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is open, navigation is as easy as flipping the page or alternately jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on Supplementary Reports. And as you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserves over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock's safety rank, an important tool to measure risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. And now we'll go into the intro to the screener, or one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. And now we will go on to the screening criteria. Today we're going to be looking for reliable companies that balance strong year-ahead prospects with good return potential over the long haul. And the first filter that we are choosing is a safety rank, and we are looking for a safety rank of 3 or better. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 being the highest to 5, with 1 including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. And by applying the first criteria, we've trimmed our potential candidates down from 5,700 to 2,163 candidates. Our second filter is a timeliness rank when you're looking for something that is 2 or better. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy-to-understand scale from 1 to 5, with those ranked 1 likely being the best performing issues on a relative basis. Most often, buyers want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're looking again for stocks ranked 2 or better, and applying that filter, we're down to, I believe, 373 candidates. Our third filter is projected 3 to 5 year EPS growth rate of at least 16%. And applying that filter, I believe we get down to, what is it, pending calculation, 89 candidates. Our fourth filter is the 3 to 5 year annual return on a percentage basis, the percentage total return of at least 10%. And by applying that filter, we go down to 59 candidates. And the last filter, by applying this screen, we've chipped away. This screen is the current PE ratio from 15 times to 25 times earnings. And by applying this screen, we've chipped away the list of prospects, I believe, down to 13. Yes, 13 candidates. And the candidates are Archrock, ticker symbol AROC, Bristol-Myers Squibb, ticker symbol BMY, Dollar Tree, ticker symbol DLTR, Brinker, ticker symbol EAT, Alexis EXEL is the ticker symbol, Excel Service Holdings, which is EXLS, ticker symbol, Expedia Corp, ticker symbol EXPE, Hewlett-Packard Enterprises, ticker symbol HPE, Health Equity Corp, ticker symbol HQY, Kirby Corp, ticker symbol KEX, Lantheus Corp, ticker symbol LNTH, ArcelorMittal, ticker symbol MT, and finally T-Mobile US, ticker symbol TMUS. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Hewlett-Packard Enterprises. Before I click on Hewlett-Packard Enterprises, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top. Now let's look at the last full page report. Hewlett-Packard Enterprises' main businesses are servers and networking equipment, as well as storage and services. The company reported a phenomenal quarter a few weeks ago thanks to accelerating demand for servers as well as improving revenue from its networking operations. Juniper, which was acquired last year, is being integrated steadily, and the pipeline of business is improving dramatically. Management significantly raised not only fiscal 2026 earnings, but the earnings for fiscal 2027 as well. The stock is reasonably valued despite its recent run, and growing cash flow will likely enable the company to pay off debt associated with its acquisition well ahead of schedule. Before we go into our question and answer session, we would like to note that we have not sold any stocks, I believe, according to this session, as the fundamentals and valuations have not changed since we presented on our stocks in the last few weeks. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions were submitted prior to this presentation, and now I will hand it off to Nathaniel and Alan. Thank you.
All right. For our first question, if we could scroll down to the bottom of that page that we're seeing there, we got a question asking, what are those three figures in the bottom right of the value line page? That box there gives certain data about a company's historical price performance and also its financial performance. In there we've got earnings predictability, which is a measure of how reliable the company or earnings forecast has been historically. It's based on the stability of year-to-year comparisons. We weight more recent years more heavily in calculating that. So for example, if a stock has historically had very volatile earnings, but recently it's been more steady, it's not going to be rated as high as a company that's always been steady, but it'll be rated higher than, say, a company with the reverse trend, where historically it's been steady and then more recently it's been volatile. Next we've got the price stability, which is based on the weekly percent changes in the price of the stock, and that measures over the past 5 years. And with both of those, the highest rating is 100 for the most stable, and the lowest is 5 for the least stable. Price growth persistence is a measure of sort of the historical tendency of a stock to show persistent price growth compared to the value line average. We have those figures there, and then we also have the financial strength rating, which self-explanatory. It's, how financially strong we consider the stock. It's used as a component of calculating the safety rank, and that follows sort of standard conventions for those sorts of ranks. So obviously, like an A++ is going to be the absolute strongest it can be, and from there. I've got a question about if we could talk about how we do the timeliness ranks. So I can't get too deep into the specific calculations for those, but with the timeliness rank, it's based on the relative price performance compared to our entire universe of 1,700 stocks for the next 6 to 12 months. And that goes from 1 being the best relative performance to 5 being the lowest. And some of the things that are factored in there are the relative earnings trend and prices, and it's all based on actual data, and we run that through a program that combines various elements to arrive at that score. And of course, since it's all relative, we recommend focusing on companies with a score of 3 or better because those are the ones that are going to be, according to our forecast, at least average performers relative to the whole universe over the next 6 to 12 months. And then I'm not seeing any other questions that we can address. If you have any, you can go ahead and submit them with Slido. That is that green S icon at the bottom of the screen. If you click that and then click on Audience Q&A, you'll be able to submit questions there. Well, I'm not seeing any other questions that we can address, so I think that that is our session today.